Well, Thursday's solid US labour market report killed the idea of a July Fed cut, but also reinforced the bull case for equities, with the S&P cruising back to fresh record highs, while fiscal jitters re-emerged here in the UK after a very brief hiatus. The week ahead looks set to be all about tariffs as the pause on Liberation Day levies expires. Participants ponder what comes next. Is it a boomerang back to the tariff levels of the 2nd of April, another taco moment, or perhaps even something in between? Plenty to discuss on the trade-off as always, so without further ado, let's crack on with the show. So plenty for us to discuss this week. We could start with our producer having taken yet another week's holiday. We could start with me discussing the brilliant hospitality that Aston Martin laid on for us at Silverstone over the weekend. But I think the best place to start is with, sadly, another viewer health warning for what is a shocking shirt that my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics has found. And Ryan, I think that I'm keen to get our viewers' comments on this. I think that might be worse than the number you had on the other day.
Well, if you go back to the viewers' comments of that shirt from the other week, they were resoundingly positive, both in our chat room, on Twitter, everywhere else. So yeah, you've got shown where to go, mate. You know.
Well, I'm glad you raised that actually, because last week I was in Specsavers at Liverpool Street, and I can thoroughly recommend them to anyone who thinks that is a decent shirt. I can provide you with a business card of who to contact, and they will sort you out very, very thoroughly indeed.
You got an affiliate deal with them or something?
I haven't, but I'm hoping for one. Shall we move on to the jobs report? Because that shirt's just acting as a distraction.
No, go on.
So the US economy added 147,000 jobs in the month of June. The UK economy probably added one, and it was the poor bloke who stitched that thing together. In any case, it was a very solid US labour market report that we had out last Thursday, killing pretty much dead the idea that the Fed would deliver a rate cut in July. And to be honest, that had always been a bit of a long shot indeed. Markets at one point last week had priced that as much as a 1 in 4 probability. Now that's seen as just a 5% chance. Why is that? Well, because frankly, the economy remains pretty resilient despite the ongoing economic uncertainty that we see. As I said, headline non-farm payrolls up by 147,000 in the month of June. We also had a net 16,000 upward revision to the prior 2 months of data. So the 3-month moving average of job gains now stands about 150,000, well above the break-even pace required for jobs growth to keep up with the increasing size of the labour force. Looking at other areas of the report, earnings, they rose by just 0.2% on the month and 3.7% on the year. So clearly reinforcing the Fed's long-standing view that there is not really any upside inflation risk stemming from the labour market at this moment in time. And then if you look at the household survey, we had unemployment ticking down to 4.1%, but the participation rate falling to 62.3%. Is this something we should get concerned about, despite that participation rate being at a cycle low? I would argue probably not at this moment in time. That's largely been driven by a significant increase in immigration enforcement activity as opposed to anything else. And the household survey has in any case been very, very volatile this cycle. So where are we? Fundamentally, this is not an economy that is crying out for a rate cut. The labour market remains pretty solid. Upside inflation risks are still there as a result of tariffs. And judging by the most recent PMIs and retail sales reports, it looks like consumer spending is holding up okay as well. So despite President Trump ranting away yet again last week, blaming Powell, blaming the Fed board, blaming basically anyone but himself, the Fed's wait-and-see approach remains pretty much the prudent one, exactly as Chair Powell outlined in Sintra last week. I think the overall story in terms of the US labour market at the moment, if you take a bit of a step back, is one where the pace of hiring is slowing, at least compared to where we were this time last year, but the pace of firing hasn't picked up either. What we're basically seeing is a labour market that is completely frozen, paralysed by the uncertainty that the Trump administration has caused with the trade and tariff policies that I'm sure we'll get into momentarily. And frankly, even if you lowered the Fed funds rate by 200 odd basis points, I don't really think it would make much difference to the employment situation in the US. It's not a cost to capital problem. It's a lack of clarity issue that the US labour market is grappling with at the moment. And frankly, given the labour market is pretty solid, this feeds into the broader story of economic resilience in the United States. That underlying resilience in turn should keep earnings growth pretty strong. We're just about a week away now from the start of Q2 earnings season, and as long as earnings remain pretty resilient and economic growth remains resilient as well, the path of least resistance for me leads to the upside for risk, and we start the week with the S&P inches away from another record high.
Yeah, very much so. And, you've got to look at the economy again and say, why is everyone rushing out of dollars still? There's other reasons, of course, the administration and what other policies may be coming up, as well as this week, the trade deals or not, as we're going to find out over the next few days. One interesting point was that we're still looking at what's going to happen with these government jobs. It's the known unknown that's coming up, maybe August, September, when we see the effects of those Doge cuts. And it was interesting to see that the government payroll actually tacked on 73,000. So here we go. Here comes Mr. Point of Order. Come on then. What was that? I was going to say it was something specific, but go on.
Well, do you want to carry on?
No. You interrupt me, mate. I'll just put the feet up. Go on.
Well, it wouldn't be a trade-off if there wasn't a sort of nerdy macro moment in it. This annoyed me. I know that's a low bar on Thursday after the jobs report. All the usual suspects coming out and going, oh, my word, what's Doge doing? What have Musk done? The government added 76,000 jobs. Yeah, they were all state and local government jobs. The federal government employee count was actually marginally negative. So it's not a case that Doge hasn't done its job. And actually, a lot of that was seasonal adjustment around teachers, if you really want to get into the weeds of it.
Yes, thank you for that. That's the point I was just about to make, but I'll let you take the credit for that one. I was going to say, yeah.
When you've rocked up looking like that, you're lucky you're still here, let alone being able to make any point.
Hey, I could get plenty of jobs wearing this, mate. I can tell you. But so it was a bit of a surprise that we tacked on that many jobs anyway. It probably, as you say, going to be a one-off. But that still plays into the numbers that we're going to get later on. As far as the Fed's concerned, the window really is, or the door's really getting tighter into how they can fit their expected 2 cuts into the next 3 meetings if we are excluding July. So I don't think the market is yet really adjusting to that. But again, we've got this situation. The economy says the Fed shouldn't be cutting, but rates up at over 4% suggests that the Fed will continue to cut at some point. But how or when they get to that is going to be the equation that the market has to deal with.
Indeed. Yes. Well, let's move on because you want to talk about the UK fiscal situation. Now, I've had a tough day, so please don't leave me in tears.
I've only got one thing to say. What do you think of the fiscal situation in the UK, Michael? And then leave it all over to you. But no,
it's unprintable.
Yes, exactly. But it's the same old. The worst kept promises in politics has reared its head again, and news that the UK Chancellor will potentially or likely to have to raise taxes at the next budget. Now, I won't get into a Michael-sized rant about the reasons why this will happen, or this will be the longest trade-off ever. But suffice to say that this is yet another election promise that's been broken due to another election promise getting broken. You can get the theme what's happening here in the UK. Tax rises are never fun, obviously, but they can sort of be justified when an economy is doing well, except that the UK isn't. Yes, we've had a positive first quarter. That's unlikely to remain in Q2. We're probably going to give some back. So a raft of tax hikes, further cuts to services is not going to improve things, more so make things worse. Now, I've never been a massive UK bear, as we always seem to do better than the worst case expectations. But I do wonder where real growth is going to come from and how economic policy is going to create it, particularly when you're talking about tax hikes. Now, dependent on what those tax hikes are going to be, my most hopeful is that the economy stagnates rather than absolutely collapses.
Oh, that's nice and bullish. Let's pop the champagne.
Yeah, buy the quid on that, Reco, eh? But for UK markets, I'm not overly hopeful. As when we start getting the super nuts of all these tax hikes or any tax hikes, we're going to get the market reaction. Now, for the pound, if the market doesn't like what's coming and it's still full of hopium for all this European magic money tree spending, defence and infrastructure, as well as the market not liking to stay in US dollars, Euro sterling could be heading much, much higher. And I'm talking about well into the 90s here. And I've got the chart up there. We've seen some significant rallies this year, and another break above 87, 87.20 could be the catalyst for that move to the 90s. So Euro might stay supported. The pound might not be supported in the next few months. And if that's the case, then this pair's heading much, much higher.
Yeah, it's a shambles, isn't it? Basically, I mean, we may as well not beat around the bush here. For anyone who is based outside of the UK, and lucky you at this point, to give you the sort of short version of what happened last week, we had on Tuesday the government trying to pass a bill in the House of Commons, a law effectively, that would have cut welfare spending by £5 billion with a B. There was a whole
pledge, by the way, an election pledge, by the way.
Yes, that's very true. And what did they end up doing? Well, about 3 hours later, they actually passed a bill, the same bill, that had been amended by their own MPs that actually increased welfare spending by £100 million. Now, that is quite frankly ridiculous. We've got a situation basically where the government can't govern. They are beholden on one hand to the gilt market, which is taking absolutely no prisoners whatsoever. And they are beholden on the other hand to their backbench MPs who don't want to deliver anything by way of significant spending cuts. And actually, I saw a quote doing the rounds from an anonymous Labour MP. One of the political journalists was running this on Tuesday. A Labour MP saying, "It's only a few £billion. I don't understand why that means tax rises." I mean, seriously. I don't want to get political on this show, but if you're hearing that, if you're an international investor or even a domestic investor, take two things in isolation. Members of Parliament of the ruling party in the UK going, basically, I don't understand how an economy works. I don't understand fiscal stability. And the second, waking up on Thursday morning and all you see on the news is the Chancellor in tears. I'm really struggling to build any sort of a convincing bull case, whether it be for gilts, whether it be for the pound, maybe equities, just because a rising tide lifts all boats. But I'm really struggling. The question I've got for you, Ryan, is, and we're not going to have a lunch on this because I haven't settled the other one just yet. We don't have a date for the budget yet. It will be late September or sometime in October. Is Rachel Reeves going to be stood at the dispatch box this autumn delivering the budget, or will it be someone else?
I say, unfortunately, yes.
She will be there?
Yeah, she will be there.
You reckon she gets ditched afterwards?
Potentially, yeah. Depends what mess she makes of it. I mean, that's been another thing, that was why some people were saying she was crying the other day because Starmer didn't back her publicly at PMQs, but he put that line to bed soon after. But yeah, I think she stays because, well, I dread to think who else would come in.
Well, and actually that speaks to the reaction we saw in markets with the 10 and 20-year gilt yield rising by about 20 odd basis points on Wednesday. And that's exactly what market participants were saying. It's almost better the devil you know. If someone comes in to replace Reeves, they are much more likely to tear up the fiscal rules and massively increase borrowing and probably massively increase taxation as well. So, I would be in the camp that it's probably politically expedient for Starmer to get rid of her before the budget. Whether I actually want that to happen, I'm not really sure at this point.
Yeah, but something you pointed out this morning, I noted, was that apparently the UK is one of the most investable places on the planet at the moment.
We're really going to get into expletives if we go down that route. Let's move on.
Set you off. Move on.
The lunatics have been let out the asylum, I think. Let's move on to maybe another asylum in Washington, D.C. and the issue of tariffs, because, of course, at the moment, at the time of recording, 88 days have passed since Liberation Day on the 2nd of April, and that 90-day pause on the Liberation tariffs, it is about to expire with those Liberation tariffs right now, I will stress, as of 2:30 on Monday afternoon, set to go back into effect on the 9th of July. Now, will that actually happen? I think that's probably anyone's guess at this moment in time. The one thing we can say with certainty, again, at the time of recording, is that quite a way from this 90 deals in 90 days that we were promised, the US has actually struck 2 deals in 90 days, those being with the UK and with Vietnam. Now, Trump is apparently going to be sending, indeed, we should give ourselves a pat on the back for that one. That shirt can be exported for much cheaper now. If there's any part. Now, Trump is going to be sending some letters out this week, basically telling countries what tariff level they have to pay. I assume those letters will be published between this recording and you watching the video. But the letters are being sent before the tariff pause expires, and the tariff level that is outlined in those letters will not kick in until the 1st of August. Add to that, Treasury Secretary Scott Bessent has been doing the rounds over the last week or so, saying, I think we can get trade wrapped up by Labor Day. Now, for non-American viewers, Labor Day is the 1st of September. So we've effectively got 3 deadlines here. And given the way things have gone previously, I wouldn't be surprised if a 4th, even elongated deadline comes into the mix at some point as well. Fundamentally, the Trump administration giving themselves plenty of wriggle room still. It feels like all the sort of pieces are aligning for this to be another taco, Trump always chickens out moment. The US have demonstrated in terms of the China trade truce that they really have no desire and probably no ability to stomach those super high tariff levies that are basically akin to a trade embargo. And I know that truce was struck in mid-May, but I really don't see why, or indeed the fact that that situation would have changed in the meantime. So I think what we're dealing with here is the umpteenth example of an escalate to de-escalate strategies. Throw some threats around, bring the other parties to the table, extract some concessions, and then run around claiming you've got the biggest and best trade deal that the world has ever seen. Of course, markets may have a little bit of a wobble on any punchy tariff rhetoric, and I certainly don't think this is much good for the dollar, although the dollar is trading a little bit firmer today. It speaks to the continued policy instability and volatility that we see coming out of Washington, D.C. But personally, as we were touching on earlier, I think dips are there to be bought in terms of equities at the moment. And we are still, if you can ignore some of the noise, on a path to trade deals being done of some form.
Yeah, at some point they'll get done. And as we know, even if we pass this tariff deadline, the tariffs won't actually come into effect until 1st of August, according to Bessent and Lutnick. So, yes, we've got another can kick of sorts, if you like. But I think we've got to look at the specific countries like Canada and Mexico, and obviously then their various related currencies. They're not so much in the firing line for these trade deals because they're going to be talking about the USMCA later on. So countries like that are probably going to be less volatile, though they will get caught up in the mix. But I expect the same thing to happen as we've had with every other deadline. We said it probably on the last show. You get to a week before, a few days before the next deadline, and the market just switches its focus to that, forgets about everything else, and just trades that. I do think, and I've been saying it for a while, that I think the yen is one of the currencies, Japan, one of the countries that potentially has the bigger price risk going on here, because it's really been strange that they haven't been able to get a deal together, given how much business Japan does, both with and in the US. And if that comes to a head that they don't get a deal done or get some sort of concession that negotiations are ongoing and they're happy to continue, then I think the yen's in for a bit of a bashing. And also because it's got a bit more monetary policy impact than, say, a trade deal with the EU. You know, if there's no deal with the EU, you're not going to get the ECB suddenly cutting rates. But no deal with Japan increases the uncertainty and potentially then is going to delay hikes even further. So, yeah, I think the yen is one currency you need to watch this week for reactions around this trade stuff.
Yeah, I would agree with that, although I would flag that there are a few sort of idiosyncratic factors going on with Japan. Obviously, we're, a fortnight or so away from elections, or upper house elections at least, which may be complicating things. Trump also now seems fixated with the issue of rice. I think it would be, frankly, humiliating for the Japanese PM to say we're going to buy rice from the US, which seems a sticking point. But the automakers in Japan are getting very desperate. There was a report out in the Nikkei earlier on saying that apparently Toyota, and this was anonymous sources, so maybe a bit of a pinch of salt needed, but Toyota have been saying that one of the things they might do is take car parts, send them across the Pacific to the United States, put them together into a proper car, a full car in the United States, in a factory there, and then ship that finished car back to Japan to then sell it to the Japanese in an effort to reduce trade imbalances with the US. I mean, that just sounds like the most bonkers and counterintuitive thing ever. But I suppose whatever keeps Trump happy, they're going to do it as they try and get a deal.
Yeah, and that would be the Japanese way as well, to do something like that. But yeah, all these sorts of things. So I think this week you got to keep glued to Truth Social, as we like to call it, the old truth bombs. because I think he's going to be playing his bad cop routine a lot this week.
Yes, I think you're absolutely right. Right, let's move on to some trading targets.
Yeah, targets. We always hear about them. We've heard a lot about euro dollar and the targets for that and where that's going, because financial markets love a target. Now, whether it's exact price targets or all-time high targets, a bit like our bet we had in the S&P, Michael. Every day someone is talking about a target.
You still need to give me a date to settle that.
Okay, well, this is my discretion. But it will be soon. Don't worry about that. Before the sun goes away, and I've got a shirt lined up for it as well. So 120 in euro dollar is one such example that we've heard about a lot over the last few weeks. But targets are pretty useless, both for trading, commentary, and for actual trading. And I'm going to give you 3 reasons why. The first one is that most targets put forward either by banks or institutions are either trying to sell services or pump prices after they've taken positions.
Oh, cynic.
Sorry?
You cynic, Ryan.
Me? Cynic? Never. If Warren Buffett issues a price target for a certain asset, it isn't because he's just looking to start taking a position. It's because he's been doing it for the last 3 months and now he wants to pump the price higher so he can take profit on everyone else jumping on board. Secondly, targets aren't important. What's really important is how a price moves and the reason why it might hit a target, the reason why it is actually moving. Now, if you understand why a price is moving, what is happening behind it, where it goes is largely irrelevant, only whether it can continue in that direction until something changes that can stop it. Now, number 3 is similar to number 2, is that traders should not become fixated with price targets. Pip profit targets are fine, depending on how you're trading. If you're scalping for 20 pip moves each time, then setting a 20 pip profit target is fine. Setting a price target for 20 pips is fine, if that's your thing. But what I often see people doing is setting really unrealistic price targets. They'll find a level to buy in euro dollar, say 118 with a 30 pip stop, and set a target of 120, and then ignore all the levels that stand in their way. And if you're going to be trading off a chart, picking a level to enter, you can't ignore any other levels you've got on a chart that stand in the way of your profits. So targets should only really be places where you will decide to do something with a trade, but they shouldn't be wild price levels and they shouldn't be boom or bust numbers either. So that's my advice for targets.
Yes, I think that's very sage advice from a short-term trading perspective, although I am going to now sit here and go, the market is probably gunning for 120 in the euro, given that the ECB's vice president came out, a fortnight ago now, because we were away last week, and said anything above 120 could be complicated. Well, Mr. de Guindos, the rare remarks that you make, where on earth do you think the market's now going to take it? Probably about 121, just to test your mettle a little bit. But I absolutely agree, and I was actually making this point in your chat room last week. Along the lines of, the path of least resistance for the time being, and I'm going to talk about this momentarily, seems to be downwards for the dollar, and by extension upwards for other G10s like the euro and like cable. And it looks like that could take us to 120 and 140 respectively over a period of time. Is that to say it's going to be a complete straight line? Absolutely not. Is that to say we're not going to get 200 pips of downside within that uptrend? Absolutely not. It all comes down to your time frame that you're trading over and also your individual trading style. And I think for the shorter term traders out there who, as you say, are looking for those sort of 20, 30, 40 pip intraday moves, your advice is, as always, very, very sage indeed.
Thank you very much, mate. And as we know with the targets, if we get to 120, the number everyone's expecting, the next one will be 125, and thus it will go on.
Yes, absolutely that. Although it did amuse me, actually. I think we are almost still there now. The euro on its 25th anniversary was bang on where it was introduced, 117.70.
Oh, how interesting.
At least pretend. I'm paying you to pretend. Come on.
Never.
Indeed, clearly. Right, let's move on to our plays of the day. Anyone would like to audition as a role for co-host on this show, just come along, laugh at my jokes, and we'll give you the gig. Oh, and wear a better shirt than that.
I've got a good tailor if they need one as well.
Right. Where am I? The dollar this week. Just alluding to this, actually, the path of least resistance seems to be leading to the downside for the greenback for the time being. Very much a sort of more medium-term view, as we were just saying. I've actually almost just done this segment, so I'll keep this relatively short and sweet. But I think fundamentally we're in a situation where, despite the US economy remaining pretty resilient under the surface, and despite the FOMC being relatively more hawkish than their peers, market participants are being very, very spooked indeed by the continued erosion of Fed policy independence and also the just general degree of policy uncertainty and volatility that we're seeing in the States as well. And I know that Europe and the UK are not exactly bastions of political stability right now, but they are being viewed as relatively more stable than Washington, DC by the financial markets. And as a result of that, the capital outflows that we're seeing, they don't really show any signs of slowing down anytime soon. So I think, I'm just going to reiterate the targets I just mentioned. The euro at 120, cable at 140 over the medium term. That will put the dollar down around the 95 figure, which we haven't seen since the very back end of 2021. So certainly one to watch there. And I think, again, just looking a little bit further ahead, what I'll be watching very, very closely indeed now is the July FOMC. We said earlier that a rate cut is frankly not going to happen, but we do have two Fed governors, Mickey Bowman and Chris Waller, who have come out and said that they think a July cut could be appropriate. Are they going to actually vote for a 25 basis point cut in July with a 4.1% unemployment rate and 150K NFP? I think if they do, it would be pretty blatant what they're up to in terms of political maneuvering. So one to watch there for the end of the month. Ryan, I was going to make another taco pun, but I can't do it.
Good. You can make a paper pun. How about that? Yes, Dynamex is the pair I'm looking at today, and my strap line heading to target is a bit of a nod to my prior topic. I've been short on this pair since up near 21, and one of my big downside levels is at 1850. Now, when I first took this trade, of course, I would like to move to 1850, but I wasn't fixated by it. If I managed to stay in the trade and we moved there, great. If not, I would manage to trade like I would any other. But here we are within striking distance of the level, and now I need to decide how to play it. Now, if I was flat here, the trade would be simple and I'll be looking at a long. But as I'm still short, I've got a big decision to make. The easiest decision is obviously to take more profit if I see the level. The harder decision would be whether I close all the trade and then flip long. So what I think I'm going to do is I'm going to go with a bit of both. I'm going to TP most of my short if I see us into that level there, maybe 1855-ish, and then try a separate long just to play the level on its own. And if the level holds, then the stop on my short should be far enough away to weather any sort of technical bounce on the level. And any bounce of that level could see a decent move up without breaking the longer term downtrend. So in such a move, I'll be using exactly the same levels to take any profits on longs if I get into them that I use to take profits on shorts on the way down. So if you're not in a trade, then 1850 is an area to look for longs, and that's what I'm going to be doing.
Very good. I'll arrange for someone to be sent round to remove the splinters from that fence you've just been sitting on for the last minute and a half.
Deary, we're going to have a long chat about trading at our lunch, mate, I'll tell you.
Oh, I can't wait. I cannot wait. Right. Well, anyway, that does bring us to the end of another show. Enough about our social diary. Thank you very much, as always, to Ryan Littlestone from Forex So Live and Forex Analytics for joining me. Thank you to our producer as well, Kyriakos, for bringing things together as brilliantly as always. Hopefully you have enjoyed the show. If you have, please do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets. Anything you'd like us to discuss next week. If your comment is just to say how nice Ryan's shirt is, then please do not bother. I believe we will be back with another episode next week. At least Kyriakos hasn't told me he's on holiday. So hopefully we'll see you in 7 days' time. Do it all over again. In the meantime, have a very good week ahead. Thank you for watching and goodbye for now.